Welcome to UTI's Swatantra series powered by ET Now. Thank you so much for joining us. Week after week, we get together in the studio here at ET Now and try and answer as many questions as we can about investing your money and using mutual funds to achieve your goal. Today, we're going to do the same thing. I have two gentlemen in the studio who have come in prepared with answers for all the questions that we have. A quick round of introduction. Nitin Singh is the Senior Vice President and Head Investment Services and Product Solutions at Private Banking at HSBC India. Thank you for coming in, Nitin. And Kuresh Morbiwala is the Director of Mark Financial Planners. Gentlemen, thank you for coming in. We were having a very interesting discussion in the studio before we started the show, and I'd like to pick up where that conversation was going. One of our audience members asked you, how does one choose a fund? Is there a formula? Is there a format that you use? And I want both of you to answer this, because we can't go technically by past performance. We can't predict future performance, and the mutual fund industry is not allowed to predict either. So then how do you choose? Nitin?
When somebody looks at choosing a fund, you just don't really have to look only at the past performance of that fund, but you have to really look at it to say how volatile that fund has been, what is the nature of investments that it's hold, what's the kind of quality that it is, that it has delivered, how is the longevity of the fund management team within that team been there, to really give you an impression of the kind of quality of performance or of returns that such an instrument could deliver to you.
All right. Do you want to take a stab at that as well?
So you have to see what is the process that the fund house is following. Is the fund house is process driven or it's a fund manager driven, right? So you have to see the quality of the team, as Nitin mentioned, and within that,
how does one see all of these things? When you say, and for both of you, when you say look at the process, look at the quality of the asset, look at whether or not it's fund manager dependent or mandate dependent. How is as a normal regular investor, find out these things about a fund?
I think one of the most interesting things that has happened in this whole information age has been the amount of data that is available
on the internet. Yeah.
On the internet. And you've actually seen a number of websites today come up that are really aimed in terms of firstly providing unbiased financial advice, which is not motivated by any investments happening through it. Sure. So whilst on one hand, I would suggest that most investors should tend to have a financial planner who really is the expert who can really provide you advice. But even if you want to do it on your own, today there are enough data sources available which would tend to rank a number of funds, which would tend to provide ratings on the basis of scales, and which is all publicly available data which any individual can actually pick up and read. Sure. And most of the parameters over there, as well as the ratings of these funds and the reason for that and the rationale is actually available as well.
How do you react to a change in fund management or to a change in the entire AMC?
Normally, what you tend to see is that if there is a change in staff fund manager, you may tend to see some kind of a performance blip within the short term. That could happen. So whether good or bad, etc., depending upon the philosophy of the new fund manager who's come in and in terms of his trying to align it. But over the longer run, really these things tend to even out, because the staff fund manager himself wasn't the staff fund manager at the beginning of his career 15 years ago.
Define long run here.
I would say at least five years plus. Okay. 5 years plus at least would be a period in which you would really tend to see that happen. The second piece over here is in terms of the change of an asset management house per se. Now again over there, really that's where financial planners like us tend to come in, because that's where you really look at the fact that if let's say tomorrow an AMC that has bought it is not really renowned for its equity prowess, for example, and doesn't really have the philosophy or the processes in place for them to really manage equity money from where they've actually bought a small fund house that might have been doing well. Now that's where people like us come in, because we then spend time in terms of really looking at saying that, is the reason for buying that really to try and replicate those processes, or is it going to get subsumed within the larger piece that's happening, and therefore does it make sense to continue?
Okay. All right. I want to open the floor up to questions from the audience. Does anybody have a question they would like to ask? Yes.
I have two questions. Whether financial planner is a must, or one can do it through internet browsing or reading papers and all?
First, to answer your first question, there's a financial planner sitting right here.
Who's actually a certified financial planner himself. So.
What we do is, how to identify the financial planner. We cannot approach all the clients, right? So we get references, by our existing clients. Some of the clients we approach, but we cannot approach everybody. So what we do is we lay out a plan for the client. sit with the client, understand his goal, which is the most difficult thing, because data collecting, we get all quantitative data. We convert that into qualitative data. So that is where we come in. We make a roadmap for you, and we lay down that entire plan for you.
Okay, just to answer your first question, there are two certifications available in the Indian market. One is the Financial Planning Standards Board of India, which certifies financial planners. If you go to that website, they have a directory of everyone who has received a certification. The second one is a certification that SEBI hands out right now, which is a Certified Investment Advisor, which you can also get on the SEBI website. So if you need one, you can get one. But the question then is, do you really need one, or can we just do it ourselves?
To have a financial plan in place is a must. You can do it through two means. One is, of course, really the right way is to really approach a person who's well qualified to do it. But even if you don't want to, there is enough self-help resources available today on most mutual fund websites, on most financial planning websites, or for example, if you would tend to go to most financial magazine websites as well, you would tend to see links for financial plans, which you can really use as a rudimentary tool to start the work around it. But before you do any investment, it is key to have a financial plan in place, because that's the only way that you'll know what your goals are. Whether your goal is retirement, whether your goal is to have your son's education done, whether it's marriage, etc. And then you can really think about what are the various pieces that are relevant for it.
In fact, one of the things that you should do is ask yourself what kind of investor you are. And I think that the biggest problem with doing things online ourselves is that you're not proactive enough to sort of keep checking your own portfolio, give yourself regular updates. And a lot of times when we decide to do something on our own, you might have 3 or 4 busy days when you don't get around to checking your portfolio. You'll miss a few opportunities in that case. So the biggest actual value that a financial planner brings is to watch your portfolio while you are busy. Unless, of course, you're the kind of investor who can do it yourself, in which case you should by all means do it yourself. We're going to take a very quick break, but when we come back, we'll talk more about how you can use mutual funds to achieve your financial goals. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you so much for staying with us. Our guests are still with us, and we're going to try and answer as many questions as we can over the next few minutes. I believe you have a question, sir. Go ahead.
I have my question to Mr. Kuresh, who is a financial planner. So actually, I am planning to buy a property in the next 3 months in Navi Mumbai, but I'm confused. Should I go for fixed interest rate, hybrid interest rate, or else floating interest rate? Because I am confused whether the banking interests are going to fall, the repo rate is going to fall or not. If the repo rate is going to fall, then I will go for floating interest, wherein I will get the benefit of the decreasing interest. So my question is, do you think so that in future the interest rates are going to fall?
Well, they're not going up from where they are. Yeah. All right.
See, over the next few years, India is going to be a developed market. In the next 10-15 years maybe. So interest rates generally will be on the lower side or what they are today, right? So I think that you should go for a floating rate, not a fixed rate loan right now, floating rate loan right now. Buying a property is a big financial decision. Now we have already decided to buy it in the next 3 months. So the property, the leverage should be not more than 30% of your monthly income. Right, so that is, so as far as the question is concerned, I am not an expert on interest rates per se, but I feel that in the next...
Sure, I'll just bring Nitin. Nitin, there must be a house view at HSBC on interest rates right now. Give us the house view there.
Well, I think, really adding on to what Kuresh is saying, there's no doubt that interest rates are on the secular decline. And, whilst you've seen RBI cut rates a few times this year, the effect of it has completely not been passed into the banking industry yet. So therefore, you will see some decline happen. Neither he nor I can predict where it will be within the longer run. But over the course of the next year or two, clearly you're not likely to see interest rates rise from where they are today, as what Faye was saying. I think the more important question, and again coming back to what he's saying, is that it depends upon the amount of leverage that you're taking and the amount of period of time that you plan to keep the loan open. Because if you were taking let's say a much smaller loan and your intent is to try and repay it as early as possible, then you have to really look at the short term.
Actually, studies show us that the Indian borrower on home loans tends to, even if he's taken a 20-year loan, tends to start closing it at about 7 years, 8 years, 9 years. So let's assume that's his horizon, and at about year number 6, he's going to start getting worried about it. Say, I want to close this loan as soon as possible. So we're looking at the next 10 years. I think the other thing that we should think about very carefully as borrowers is base rate versus lenders who do not give you the base rate, because there are a lot of NBFCs right now who don't offer you the base rate and who still are on the BPLR system. In a scenario where we are likely to see interest rates come down, how important is it to use the base rate system?
Extremely.
Could you explain it to him?
So I think the point that Faye was just making is that it really depends upon the kind of loan that you're taking. So you may take a floating rate, but it's very important for that floating rate to be essentially fixed to a base rate. In terms of the money that is basically the rate that is actually declared by the bank, because what will tend to happen is that therefore whenever that rate goes up and down, your loan is then really tied to it, and therefore as rates decline, you will automatically tend to see the interest rate on your loan decline as well. So I think which is why it's critical that you take it from an established borrower and somebody that is credible, and of course more importantly really look at the leverage that you're looking at. I think the other pieces, and which is a very interesting piece of conversation, is that you rightly said that whilst most Indian borrowers tend to take loans for 20 years, but they really want to pay it off in 6 or 7 years, because for most people they want that security, security of having the house that they own completely free of encumbrances. Now that is not necessarily the smartest investment decision. That is because that is just driven by I would say pure emotions actually, because in most cases you would actually tend to earn more money by actually investing that money.
No, but also I would also say that when the young gentleman decides to close his loan 7, 8 years down the line, it's also the point where he'll decide to upgrade his home.
Very true.
So a lot of times we tend to circulate that money and then upgrade the home. So we always have a home loan running for the banking industry. So don't worry about us.
No, and I think hopefully the earning that you are at today and the earning that you will be at 7 years later will also be hopefully be a multiple of that.
Yes, please go ahead.
My question is very simple. When a person who puts his whole life saving and he expects a fair good return and save money, so how he should go about it? He should go for debt funds or equity or...
Okay, hang on. When you say your whole life saving, are you talking about your pension or your accumulation?
Yeah, person who is retiring. Say person retiring.
On retirement. What do you do with your retirement corpus?
Exactly.
Is your question. Post-retirement. Nathan, you want to take that?
As you reach closer to your goals, the amount of volatility that you can have within your portfolio has to be much lesser, right? Secondly, you have to really be realistic about what the money that you have today is going to fetch you in terms of return. Now, you might say that I have 50 lakh rupees and I wanted to give 50,000 rupees a month. But as Quresh was saying, firstly, you have to realize that that's possible at all or not. Because that might give you that for the next 10 years or 15 years. But is it in a position to be able to give that to you for the next 25 to 30 years? Because for most people today, because retirements are happening faster and our ages are getting extended, you're really not going to get anything in terms of pension. So you have to be very judicious about it, which is why even if you haven't sat down for a financial plan yet, it even makes sense to sit for a financial plan now, because then you know what is the money that you need to set aside to ensure that you are able to tide over the next 5 to 6 years. What is the money that can be set aside to ensure that 10 years later you've got that kicker for it to happen for the next 10 years, assuming that the only goal is retirement and no other expenses.
Sure. So normally the advice that we give someone who's about to retire or someone who has retired is that you have to first make sure that you have health insurance, so that you're not breaking any of the investments that Nitin mentioned in case of a health emergency. Then you have to make sure that your monthly expenses are being provided for through some sort of income or the other. Normally retired people like to travel, like to visit grandchildren, like to visit children, set aside money for that sort of thing. Things that you wanted to do this entire time that you haven't because you were working. So put aside all of that money, and then the money that you can put aside for 10 years, 15 years, it has to have an equity component, and you have to have a financial planner look at it for you. So if you put it in different buckets that way and look at it separately, you'll be able to make a clearer financial plan.
And this debt funds, if you opt for a dividend option, there's a huge tax. But if you opt for a systematic withdrawal or something, the tax is less. Please explain something about that.
See, the dividend distribution tax is deducted out of the dividends that the fund is paying. Now, if you do an SWP before 3 years, because last year they changed the law, So if you do it before 3 years, then you don't get the capital gain advantage. Then you are taxed at the marginal rate of tax.
Okay.
So if you are taking money out of debt funds before 3 years, completing the 3 years from the first installment, then from the first installment you'll start paying on capital gain tax.
But even SWP or systematic
Even an
withdrawal
SWP
is
will
better
be
than the
taxable.
dividend option, probably.
If you do it after 3 years.
If you do after
3 years. Otherwise, you will be taxed at the marginal rate of
But
taxation.
you have to realize that the dividend option, you're taking out the returns, and in SWP, you're pulling out the capital. There is a difference in what you're doing fundamentally, which is why the tax treatment is different as well. All right, I'm told we have to take another very quick break. We'll come back and answer more questions on the other side. Remember, there is a website at the bottom of your screen right now. If you'd like to join us in the studio or give us your questions from home, do that. Log on to our website and leave us a question. Stay with us. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you so much for staying with us. We have more questions to work through, so I'm going to get straight to it. The gentleman in the back, go ahead.
We are living in this era when there is not only information, but it is explosion of informations. Now the question is which one to pick up and which one to decide that what is right.
All right. So how do you choose, and I'm going to take his question one step further, how do you choose what information to pay attention to and what to react to? Because there's so much of it.
My personal view, you don't need to react at all, you have to stick to your financial plan. As far as data is concerned, you get data. I think you should ignore the data, stick to your plan.
Okay, Nitin?
I think the point that he's making is very valid. If you have a financial plan, you should really try and sift through this information and really not get perturbed by all of these events, because all of this stuff is all about event. Today something has happened, tomorrow something has happened. And I think on top of it, and just to belabor the obvious, it is important therefore that you have professionals, because then the professionals really able to come back to you and tell you what is something that is really going to solidly impact your portfolio, in terms of there's a credit default event, is it going to impact your fund, rather than something that is just noise.
Whom to choose out of these people who suggest?
Let's simplify the question a little bit. There are a lot of fund houses and AMCs that offer mutual funds. We talked about how to pick a fund. But how do I pick a fund house? Because these are all big brands. These are all brands that we're all familiar with. How do I decide which one I'm going to go with? Can you give us a checklist that we can use?
I think in fact the checklist that we had used for the fund actually stands true as much for a fund house as well. Okay. Because we talked about longevity, we talked about volatility, we talked about the philosophy of the fund house, we talked about how it has been through bad and good market cycles, how true have they been. So I think all of those tend to fall true for a fund house as well. Is there something else?
See, ultimately it's your money, so your comfort level. So if you are comfortable with a particular brand, now obviously you will be comfortable with a big brand only. So stick to the brand, and most of the fund houses they'll deliver over a period of time.
And I think one of the things that I do have to say is that the regulator has actually been doing a lot of work in terms of really looking at underperforming fund houses, as well as fund houses that they believe are not meeting the remit that they have set for investors, and they are actually becoming much more vigilant and much more to some extent, a lot of people say intrusive in terms of asking questions as to why there is something that is not the nature. So normally that tends to happen over a period of time. But if you're able to get all of these questions right, you would normally tend to gravitate towards a certain set of people, which would tend to form anyways about 70 to 80% of the industry AUM.
All right. We have another question. Yes.
Suresh Khandelwal. See, funds which has to be invested, it should be invested to 3 to 4 companies, 3 to 4 mutual funds other than one mutual funds. What would be the better?
Always, right?
Yes, diversification is always better, right? Diversification would always be better. So, see, again, as I said, it depends. You might have a large cap in your portfolio, mid cap in your portfolio, flexi in your portfolio, a corporate debt fund in your portfolio, short-term income fund. All of it is meant for different needs, and all of it goes together to put together a portfolio. Quresh right at the beginning talked about the first thing, saying asset allocation. Asset allocation is to say you put diversification between equity and debt, but there's also further diversification that is required in the instrument that you hold. So it is critical that you have a well diversified 10 to 12, not also completely split, but
10 to 12
across equity, fixed income,
Maximum
liquid
10 to
funds,
12.
yes, not
A
more than that.
maximum of 10
Yeah.
to 12.
Would you?
Maximum 10 to 12. Yes.
Maximum 10. But across equity, fixed income, etc. I'm not advocating somebody to put money into 10 equity
10
funds.
equity funds, yeah.
Yeah.
Explain to us also, taking that question forward, what a core holding would be in that portfolio. If assume I'm a long-term investor, I have 10 years or 15 years at least right now, and I'm putting together a portfolio, like you said, of 10 mutual funds. What portion of that needs to be core? What portion of that, what forms the rest of it?
The core portfolio should be obviously of the large cap fund. The percentage depends on what is your risk appetite, right? Because if you are, say 10 years is a medium term horizon, so a combination of large cap, balanced and flexi would do the job, right? Now, depending on your risk appetite, how much volatility you can, withdraw, and which method are you following? Are you giving a lump sum, or you are willing to do a systematic investment plan over the next 10 years? I think that.
So I would never recommend anybody invest a lump sum.
Absolutely. We also don't recommend that.
Okay.
We also never recommend
So
that.
normally when you have those 10 funds, it's important that the main 3 or 4, which is the main portion of your investment and a larger allocation, is in either equity diversified or large cap funds, because they will give you a steady return. And then you can add the mid cap element to it to sort of give you a delta on top of that, because there will also be a volatility that comes with mid and small cap. And then you have your fixed income or your balanced fund based on your goals. Do we have any other questions? Yes. Okay.
How do you look at real estate as a asset class?
Technically, it's a home that you need to live in. So if you're considering the second home as an investment.
Any asset that you invest in, it depends on when you get into the asset, right? So if you had got into real estate in 2003, you would be a happy guy today, right? But if you had got into real estate 2 years back, you would be losing money.
So I assume the question he's asking is if he gets in now.
If you get in,
Okay, so hold on. So let me answer this in 2 things. See, he was talking about rental yield. See, what is the reason why you get into any investment? Because it has to beat inflation,
Sure.
minimum, and it has to deliver you a decent rate of return. And the most important thing which we don't think of when we do real estate is liquidity, which is that when you need the money, you're able to get it out. So yes, real estate should form part of a portfolio, but it can never be the predominant portion of portfolio, which is generally the case with most Indian investors in the past, right? As Faye said, it is important to have a house which you stay in. Now, when you get to a second property or a third property, that is where the question comes in to say, what is the portion of your portfolio that it should be? It should never be large under any circumstance. And I think third is you have to really then look at quality. Like you look at quality for everything else,
Yes.
you have to look at quality here as well. Because the question is, quality will give you better returns, it will give you better rent, and it will also most importantly give you better liquidity.
I think with real estate, where we are right now in the market, there's a lot of things being written about the real estate market. And just like the stock market, it's very, very difficult for investors like you and me to time it, to know when it's going to turn around, when it's going to start moving up. And I think the most unfortunate thing about the real estate market is for as long as we are buying, we want the prices to come down. As soon as you buy, you want it to start coming up again. So it's impossible to find that, that moment, that balance. But from what we've studied right now of the real estate market, there is a lot of inventory. Builders are willing to offer discounts, and that could change when maybe interest rates come down. That could change when sentiment improves, when buyers like yourself and the gentleman sitting next to you go out with your checkbooks. Once that happens, then you will start to feel like you missed the bus. So if you feel at any point that this is a really, really good deal from a great developer in a great location on a great building, then you should just go out and get it. Because we don't know when that will change, and that could be at any point now. All right, on that note, I'm told we've run out of time on the show. Gentlemen, thank you so much for spending time with us. It's been a wonderful half hour. If you have a question for us, tweet it out, #Swatantra, or you can log on to our website, Be Swatantra. That's on your screen right now. You've been a wonderful audience. It's been wonderful to spend time with you. Thank you so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का. Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.